Good morning, my name's Sam Hill. I'm a client portfolio manager on npower's optimisation desk. Here with today's market update for Thursday, the 29th of September. To summarise this morning, the power market is reasonably slow to get going, with only Q1 17 trading so far. Contracts that have traded in the gas market, however, are up on last night's close. This is following a push-up in oil prices following OPEC's announcements last night that they have agreed on a cap on production. A reasonably flat gas system and pound also plateauing are doing little to drive the direction of prices. For more information, please get in contact via the email address provided, or please continue to listen. Okay, the UK gas system has opened a touch undersupplied, with the current line pack forecasted to be 0.5 MCM short. Demand on the gas system continues to be below seasonal averages, with reduced IUK interconnector exports and less pressure from gas-fired power generation. The two unplanned events affecting Norwegian Scarf and Kristen have an intraday reduction of 18 MCM. However, with some of those flows heading towards Europe, there has been little effect on the UK system. Currently, Southwick send out at 28 MCM, and some comfortable flows through the St Fergus terminal are helping support the UK gas system. Moving on to power, peak power margins for today are around 11 gigawatts. Wind generation is currently making up 15% of the stack at 5 gigawatts, which has taken some of the pressure off CCGT, which is generating around 15 gigawatts and making up 47% of the stack. Wind has further scope and could potentially ramp up to 7 gigawatts later today. The Dutch interconnector is importing at its full capacity, whilst continued disruptions see the French interconnector importing at around 10% of its capacity. OPEC announced last night that they've agreed a cap on production, with the Saudis deciding the price of oil is more important than the free market in oil. This news, coupled with the reduction in US oil inventories announced yesterday, has seen oil pushed up, now valued at $48.59 per barrel. The main aim of the surge in production from OPEC earlier in the year, and more notably the Saudis, has been in the bid to drive out US fracked gas interest. We saw the first US shipment of fracked gas arrive in the UK earlier this week. However, new reports are now indicating that the US's main export route will be to South America, where demand is higher. This has perhaps spurred OPEC on in their decision, with potentially less of a threat coming from the States. Elsewhere, the pound is currently valued against the euro at €1.16. Some net lending and mortgage data out of the UK may provide some further direction. GDP and unemployment data out of the States will likely affect the dollar, which could trickle through to the pound and dollar-based commodities like oil. Thank you very much for listening. Have a fantastic day, and we'll catch you same time tomorrow.